Okay, so good morning and welcome to today's webinar on developing Hong Kong as a green and sustainable infrastructure hub, organized by the Hong Kong Green Finance Association's Policy Sub-Working Group. The research project is led by Florence Yip, the PwC Senior Advisor, in collaboration with a cross-sector of industry experts. My name is Jenny Lee, the Undersecretary for HKGFA. So before we begin the session, a few words on housekeeping. This webinar is recorded and broadcasted live on YouTube and is also available on the HKGFA website. During the webinar, you will be able to post your questions in the Q&A box, and then we'll be able to answer the questions at the end. So we have a full agenda today with the opening remarks from Joseph Chan, Undersecretary for Financial Services, the Treasury, who unfortunately is unable to join us, but shares with us his speech in a recorded message, followed by the research report findings from Florence Yip, and then the panel discussion. So without much further ado, I will pass the floor to Joseph Chan for the opening remarks.
Distinguished speakers and guests, ladies and gentlemen, good morning. It is my great pleasure to speak to you all today at this webinar organized by HKGFA. First of all, I would like to thank HKGFA for organizing today's webinar, as well as its continuous contribution to the development of green and sustainable finance in Hong Kong over the years. Combating climate change is an important issue across the globe. When COP26 was held in Glasgow last year, world leaders reaffirmed their commitment to combating climate change. To tackle this global challenge, financing is required in a massive scale. Hong Kong's status as Asia's leading international financial center, ranked number 3 in the world and number 1 in Asia under the Global Centers Index published last month, has well positioned the city to be the green and sustainable finance hub of the region, raising green and sustainable capital and offering green financial products. Green and sustainable finance is indeed one of the current administration's policy priorities, and we have rolled out a series of measures to develop green and sustainable finance in Hong Kong. Since the launch of the government Green Bond Program in 2018, a total of over $7 billion equivalent of green bonds has been successfully issued. The issuances across a variety of tenures and currencies were well received by the global investment community, setting an important new benchmark for potential issuers in Hong Kong and the region for enriching the green and sustainable finance ecosystem. The government green bonds issued so far have been used to finance a total of 14 public works projects that bring significant environmental benefits to the community. The government issues the Green Bond Report annually to provide information on the allocation of the green bond proceeds and expected environmental benefits of the projects financed. In order to issue green bonds regularly and expand the scale of the government Green Bond Program, we have doubled the borrowing ceiling of the program to 200 billion Hong Kong dollars. As announced in the 2022-23 budget, we will continue to issue in this year green bonds totaling about $4.5 billion equivalent, which includes the first government retail green bond with the subscription period starting on the 26th of April. To support green and sustainable finance and to support the bond issuance and lending to further enrich the finance ecosystem in Hong Kong for green and sustainable instruments, we launched a Green and Sustainable Finance Grant Scheme last year to provide subsidy for eligible bond issuers and loan borrowers to cover their expenses on bond issuance and external review services. The scheme has been well received by the industry, with over 60 applications already approved under the scheme, covering various kinds of green and sustainable debt instruments. Supporting more enterprises in obtaining green financing will facilitate the transition to low carbon and emission reduction and promote the development of green finance in Hong Kong. Therefore, we have recently lowered the minimum loan size threshold from 200 million Hong Kong dollars to 100 million Hong Kong dollars in respect of applications for subsidies for covering external review costs under the scheme. Over the last few years, we have seen green bonds gaining popularity and traction in Hong Kong. We have seen local, mainland and overseas issuers using Hong Kong's platform to issue green bonds. Multilateral agencies such as the World Bank, the European Investment Bank, and the Asian Development Bank have also made use of Hong Kong's platform to issue green bonds, demonstrating their confidence in Hong Kong as a sustainable finance hub of the region. In fact, the volume of green and sustainable bonds arranged in Hong Kong in 2021 amounted to $31.3 billion, which is 4 times of the 2020 figure, and accounts for 1/3 of the Asian green and sustainable bond market. In addition to traditional green bonds, we've also seen the world's first real estate sector's green convertible bond, Asia's first green retail certificate of deposits, the world's first Guangdong, Hong Kong, Macau, Greater Bay Area themed green bond, as well as the first offshore ESG A-shares ETF issued or listed in Hong Kong, demonstrating the wide range of sustainable financial products developed in our market. Of course, the development of sustainable finance is more than green financial products, and the Hong Kong SAR government and our regulators are working on multiple fronts to promote green and sustainable finance. To coordinate the management of climate and environmental risks to the financial sector, accelerate the growth of green and sustainable finance in Hong Kong, and support the government's climate strategies, the Green and Sustainable Finance Cross-Agency Steering Group was established by the relevant government bureaus and financial regulators in May 2020. Following the publication of the Common Ground Taxonomy report by the International Platform on Sustainable Finance, the steering group will, with the aim of aligning with the Common Ground Taxonomy, explore developing a green classification framework for adoption in the local market, which facilitates easy navigation among the Common Ground Taxonomy, the mainland's, and the European Union's taxonomies. The steering group is also promoting disclosures aligned with the recommendations of the Task Force on Climate-Related Financial Disclosure, TFCD, across relevant sectors no later than 2025, and the suitable adoption of the sustainability disclosure standards to be developed by the International Financial Reporting Standards Foundation. Carbon market opportunities are also one of the priorities set up by the steering group last year. The steering group has completed a preliminary feasibility assessment for Hong Kong to pursue carbon market opportunity and is of the view that Hong Kong's success factor in adding value to global carbon markets lie in our close links with the mainland, which enable us to facilitate global capital flows into the mainland's carbon markets. The steering group will proceed with the next steps, including developing Hong Kong into a global, high-quality, voluntary carbon market, working towards establishing the Greater Bay Area Unified Carbon Market, exploring opportunities to link up international investors with the mainland trading systems, and strengthening cooperation with the Guangzhou Futures Exchange on carbon market development, with a view to developing Hong Kong into a regional carbon trading center. At the end of the day, financial service industry is a people's business. Thus, talents are key to success of the development of green and sustainable finance. The Chief Executive's 2021 policy address announced to add the new profession of professionals in environmental, social, and governance (ESG) to the talent list with a view to attracting more talents in this respect from outside Hong Kong. In addition, the government will study to include more courses related to ESG in the list of reimbursable courses under the Continuing Education Fund and incorporate more ESG-related topics in the business and finance programs in our post-secondary education. Having regard to the new trend of developing low-carbon and sustainable economy, as announced by the Financial Secretary in the 2022-23 budget, we plan to launch a 3-year pilot green and sustainable finance capacity building support scheme. Under the scheme, subsidies will be provided for the training and acquisition of relevant professional qualifications, so as to encourage practitioners in the financial and other relevant sectors to participate in the training, expand the local green finance professional team and talent pool, facilitate the industry to enhance its resilience to climate risks and to seize the opportunities in this area. According to the current plans, the scheme will cover practitioners in the financial services and persons from relevant sectors who need to build up the knowledge and green and sustainable finance. Eligible courses or qualifications to be subsidized will be devised after taking into account views of the relevant parties and other places' experiences. Ladies and gentlemen, as Asia's leading international financial center, Hong Kong is well positioned to be the green and sustainable finance hub of the region. We will continue our efforts and work closely with you, the market practitioners and relevant stakeholders, to develop and promote green and sustainable finance in Hong Kong. On this note, I would like to thank all the distinguished speakers for the upcoming sharing, and I wish you all a future blessed with thriving, sustainable businesses. Thank you.
Okay, so that was the speech from Joseph Chan. And so now we move on to Florence, who will basically build up in terms of the policies and recommendations from the research report findings that she led this year. So over to you, Florence.
Thank you, Jenny. Good morning, ladies and gentlemen. I'm Florence, Senior Advisor of PwC. I am honored to lead a report comprising members from academia, pension funds, NGO, fund managers, lawyers, accountants, consultants, and tax specialists. We worked for about 10 months, and a report was issued on the 4th of February this year. Next page. Our report is not too long, only 41 pages. So I try to explain that as well as our recommendation in the next 6 to 7 minutes. Next, please. Mr. Joseph Chan has already alluded to the importance of carbon neutrality before 2050 and the contribution of infrastructure that might contribute to this objective. So we actually have in this report, we will focus on the financial vehicle of the investment funds as the green and sustainable bonds and loans market are relatively more developed. Next, please. Okay. Green and sustainable infrastructure is critical to the transition to a low carbon economy and delivering sustainable impacts. When we were working on the report, it remained an issue as to how to identify and define such projects. What is infrastructure and what is green and sustainable? So different frameworks and standards are evolving. Investment fund is an important vehicle in closing the huge funding gap for green and sustainable infrastructure financing to achieve its global climate goals and promoting sustainability. Now, Hong Kong is a leading international financial center, and we have a well-established common law system and attractive fund structures for investors and fund managers. In particular, Hong Kong tax regimes and incentives can be and should be leveraged to promote green and sustainable infrastructure financing. Next slide. In our report, we actually have come up with 4 key recommendations plus other recommendations. So the 4 key recommendations I will explain in more detail later on. For the other 2 categories of recommendations, we actually will recommend the Hong Kong government and the relevant authorities to consider taking steps to enhance and encourage best practices in sustainability to be applied to green and sustainable infrastructure projects, both locally in Hong Kong and regionally. Further, enhancement of the legal and regulatory environment for investment funds to set up and operate in Hong Kong to facilitate investors and asset owners' investment in green and sustainable infrastructure projects. Next slide, please. So the first key recommendation is rather technical. We have come up with a number of recommendations in relation to revising or adding new or changing tax policy and incentives in Hong Kong, ranging from expanding the current definition of infrastructure in our Unified Fund Exemption regime to include new infrastructure, green infrastructure, sustainable infrastructure, etc. And there are various also other kind of tax technical points that I will not bore you in this webinar, but they are detailedly explained in our report. Next slide, please. Our second key recommendation is to recommend a mandatory Provident Fund Authority to promote investments with green and sustainable impacts by mandating MPF fund managers to allocate a certain percentage of their portfolios to ESG or climate-related products, and considering infrastructure as an eligible asset class on the MPF platform. Next slide, please. Our third key recommendation is regarding extending subsidy to encourage the redomiciliation as well as setting up of infrastructure funds in Hong Kong under the limited partnership fund regime. Currently, such subsidy is only available to open-ended fund company, which we find rather limited because many private infrastructure investment funds are set up as limited partnership. Next, please. The last key recommendation we recommend is that we have noted that since summer 2021, China has launched a couple of infrastructure REITs. And as the date of the report, 11 infrastructure REITs were on the market in China. So we believe that infrastructure REITs would be an attractive product to investors in Hong Kong as well. So we recommend that such products should be added to our cross-border scheme, the Connect scheme, or mutual fund regime, and should be made available, accessible to investors in mainland as well as in Hong Kong, thus to promote the flow of capital into the green and sustainable infrastructure financial products. Next. Other than the 4 key recommendations, we also, in the report, also outlined further recommendations for the Hong Kong government on encouraging best practices in sustainability to be applied to green and sustainable infrastructure projects. For example, provide guidance to the construction of infrastructures in the proposed Northern Metropolis and the Lantau Tomorrow Vision development plans to ensure they satisfy the recommended green or sustainable standards from the outset. Collaborate with cities in the GBA and beyond for strategic infrastructure planning, standard setting, and carbon emission data collection. Next slide, please. Moreover, the enhancement of Hong Kong's legal and regulatory environment can also facilitate investors and asset owners' investment in green and sustainable infrastructure projects. The report suggests that Hong Kong's Exchange Fund and Future Fund can take the lead to invest in Hong Kong green and sustainable infrastructure initiatives, or even set up dedicated portfolios to invest in early stage infrastructure projects in the GBA. Climate resilience and sustainable development are intricately intertwined with the global awareness of global risks, climate risk, and the call for a green and sustainable futures rising to an unprecedented level. It is also time for Hong Kong to leverage its strength in financial services to deliver green and sustainable impacts. Thank you. This is at the end of my presentation.
Thank you, Florence. That was very informative. Obviously, we have a lot more that we can be doing to unlocking the capital flows for infrastructure through Hong Kong as an investment hub. So next we have a esteemed panel of speakers that will be moderated by Sally Wong, who is the CEO of the Hong Kong Investment Funds Association and also the Vice President of HKGFA, to discuss the opportunities and challenges in green and sustainable infrastructure. So Sally, the floor is yours.
Thank you, Jenny. Before we start the discussion, I would like to invite our panel members to each of them introduce himself or herself, in particular his involvement in the green and sustainable infrastructure financing space. Maybe we'll start with Alfred first.
Sure, thanks, Sally. Thanks for having me. This is Alfred from Amundi, and I lead the institutional business for Amundi in Hong Kong and Macau. So Amundi has been a leader in green and sustainable investment solutions globally. And I hope today I could bring some experience and insights that we have already partnered with institutional investors in Europe to share to the audience what could be done in this area.
Okay, thank you. And then we have Chi Zhang. Please unmute yourself.
Yeah, thank you. Hi, this is Chi Zhang from AIA. I'm leading the infrastructure debt investment for AIA Group companies. So we are actually invest across the globe on various sectors, including renewables, particularly in renewables, utilities, energy, and also include transportation and social infra. So happy to be on the panel and discuss with everybody.
Yeah, and then Ivy.
Hello everyone, this is Ivy from Mizuho Securities Asia. I'm the head of Sustainable Finance APAC at Mizuho. I led the ESG initiative at Mizuho, and I contributed to the report launched a couple of months ago on the green and sustainable infrastructure financing. And I'm happy to join this discussion and contribute some of my thoughts. Thank you.
Thank you. Last but not least, Eugene.
Yes, good morning. Gene Sullivan with the International Finance Corporation, based here in Hong Kong. The International Finance Corporation is the largest global development institution focused on the private sector in developing countries. We're a member of the World Bank Group. I'm with the Infrastructure Investment Department at the IFC. We invest across the capital spectrum in companies operating in renewable energy, water, waste, transport, TMT, and logistics. Sustainability is a cornerstone of our investment philosophy. Besides investing for our own account, we partner with other financial institutions to help them increase their exposure to sustainable infrastructure in developing countries. And to give an indication, last year we invested about $23 billion US, including about half from partners and about half from our own balance sheet. And look forward to the discussion this morning.
Well, a very broad spectrum. So in the next 20-25 minutes, we'll have a discussion amongst ourselves. And then at the same time, we will welcome questions or comments that you can send through the chat box. We'll try to entertain them as much as possible through the discussion. If time allows, then we can have separate Q&A session. So in the discussion, first of all, one point is that because the term green and sustainable infrastructure financing is a mouthful, so going forward, I would be using the acronym GSIF to stand for that. And to start the discussion, probably I would like to invite Eugene to give us an overall macro view as to what this is happening on a global scale, in particular in Asia Pacific. What's the key trends and observations?
Sure, thanks, Sally. So I think when we look at the experience of infrastructure investing in Asia, generally it has been underweight compared to other regions of the world. And there's a couple of reasons for that. Some of them are changing, which I think makes this an interesting time for infrastructure investing in the region. So one aspect is the role of the private sector versus the public sector. So for investors looking to deploy capital, equity capital into the infrastructure sector, the more market share the private sector has, the more investable opportunities there are. And that is a feature of Asia that frankly still exists. There is more PPP and private sector activity, but the reality is that the public sector is still playing a very important role in the region. Another factor is the pace of pipeline flow. And what we've seen historically in Asia is that the pace of pipeline flow and infrastructure has been relatively slow. So long gestation times, projects taking a fairly long time to reach an investable condition. And what that has meant is that the corporations, EPC contractors that are developing these projects, they have tended historically to have enough financial resources themselves to hold on to those assets. And this is in contrast to what we see in other regions of the world where corporations and contractors are very often keen to quickly flip the asset to financial investors who then become the long-term owners of the assets. And this is something that we see changing in Asia. So the pipeline of investable assets is improving in Asia. And this we see as really a key fundamental trend and something that is a very strong positive for investors looking to get exposure in the region. And of course, an important part of this is the climate objective that we have as a world, but certainly governments in Asia, including the government of China, having a very clear policy direction, which will underpin more deal flow and create more opportunities for investors.
Mm-hmm. And Ivy, do you share similar observation in terms of the pipeline deal flow as well as the PPP, and in particular in the space of debt capital market financing? What are the key trends that you're seeing, and especially based on your interactions with the clients, what are the emerging demands?
Thanks, Sally. There's definitely an increased interest in infrastructure financing. We have a lot of discussion with utility clients looking to, get funding for their projects. Like we talk a lot about green hydrogen nowadays. So a lot of these kind of inquiries. And I would really say that the robust development of sustainable finance market actually brings new hope for infrastructure financing. Before the proliferation of green and sustainable finance market, infrastructure projects were mainly funded by project finance, which based on equator principle as the guiding rules. But equator principle is just serve as a risk management framework for financial institutions to identify assets and manage environmental and social risks when financing projects. with the booming green and sustainable finance market that we've seen over the last couple of years in Asia Pacific or a decade long in more advanced market like Europe, the market is now offer a new tool to scale up the investment into infrastructure projects that create, environmental and social benefits. Because we have the sustainable finance taxonomy, like the climate bonds taxonomy, the EU taxonomy, and also PBOC's green bond catalog in China, which are, classification systems for sustainable economic activities that are technically, a green list or a positive list that really give clear definition of what is green. So this is addressing one of the key challenges with green investment, which is lacking of clear definition. And I'm sure like Alfred and Eugene can, share their views on this as well. And in terms of pipeline, the Green GBA initiative, actually, bring a lot of new attention into what are the potential infrastructure investment opportunities in our neighboring region. And we've seen a lot of project, building up in the pipeline, and we've also seen a growing number of infrastructure projects being, seeking refinancing through green bonds, sustainable debt instruments. So I think this is a new trend that worth to pay attention to.
Thank you very much, Ivy. Now that we have been hearing more on the supply side, we can probably move a bit more into the demand side. And maybe start from Chi, because from the insurance sector, you said that you have been investing quite heavily in the infrastructure, starting from utilities, social, and roads and transport. So if we take a step back, how important is infrastructure as an asset class, in particular the GSIF, in your investment allocation and your portfolio? Please unmute yourself. Yeah.
So yeah, infrastructure as an asset class generally, as you know, carries stable debt rating, long duration, high recovery rate. So that's the very key aspect of infrastructure as an asset class, and very distinct aspect of infrastructure. So this is actually a perfect fit for investors like ourselves, who are actually seeking long duration and high asset quality and stable return. So we have, as you may know, that we have strong presence in 18 markets around APAC. So we actually actively seeking opportunities in domestic assets around the region. Strong economic development in the region over the years is leading to greater demand for products like life and annuity products. Then those products that we sell in the region need to be supported by long-dated investments. So actually, so infrastructure plays a very important role here. So we focus to play as a leadership role in the region to drive the economic and social development across the region. So this is through investing in infrastructure assets, which actually provide the returns for the needs of our customers, for our policyholders, and also this will also help the development of the regional economies. So that's why infrastructure is a very kind of important asset class that is being emphasized and heavily invested in our company. So in terms of green and sustainable infra, this has been definitely a focus for our infrastructure investments. So as you know, the ESG has been heavily emphasized by more and more investors. And our research also continues to show that companies with good ESG practice can deliver definitely high returns and demonstrate better risk management and create a sustainable value over the long term. So we are very kind of focused looking at both the environmental, social, and also the government's nature of these investments. Given our investment, they are long-term nature. So we have been doing that quite a long time ago, even before that ESG has gained a lot of attractions nowadays. So we have been publishing our ESG annual report since 2017. And now the ESG is actually firmly integrated into our investment process. In our latest ESG report, we disclosed that we actually built a internal ESG rating system to kind of investigate all the investment that we made. So the investment that we made need to have a sound ESG aspect. So definitely green and sustainable infra. This has been very much emphasized in our investment process. Some other examples like our adherence to UNPRI, and you may hear that we have committed to net zero by 2050. And we also committed to SBTI, so Science-Based Target Initiative. So that is also help to not only just ourselves trying to set up a emission reduction target, but also we want to use our say as a major investor in the region to help encourage our invested companies to set up ambitious emission targets to achieve that together. And another example is that also we made full divestment of our coal investment last year. So this is another example. So I may stop here. Yeah, and pass to other audience.
Yeah, we will definitely come back to you. Divestment is one of the strategies. And Alfred, from a firm which is a key player in this space, how do you get exposure to the infrastructure asset class, in particular GSIF? And what particular focus strategies are you employing? And please share experience.
Thanks, Sally. I'm more than happy to. So I would say in general, infrastructure as an asset class is getting a lot more important for different type of institutional investors in their investment portfolios. Just like what he just mentioned, for insurance companies, definitely there's a need for them to have such a high quality assets, long durations, as well as a stable income generating vehicles for them to match their liabilities. So you may say back to 1980s or 1990s, there are very little discussions related to infrastructure investments, maybe because due to the lack of clarity, transparencies, or deal flows. But however, we have seen it's been changing, and infrastructure investments has grown rapidly. Maybe since 2010s, there's over 100 billions of US dollars new infrastructure investment every year, and close to more than 100 funds closed in these particular asset classes. So for your reference, from some of the annual reports from different well-known university endowments, insurance companies, as well as public pension plans around the world, the allocation to infrastructure has been increasing in the past decade from 0 to 1%. From now on, it's 3.6 to 5% already, which is a huge development in the past maybe 8 to 10 years. So this has proven that the allocation of infrastructure investment has been growing, and we strongly believe that it will keep growing as well. So I would say there may be three main reasons for that. I guess she has already mentioned the risk and return profile. And another point of view is the stability of the investment, simply because some of the investment actually could have government support and guarantee if it's related to social or energy supplies for the country. And last but not least, it is a problem that we are all facing here is longevity. So like pensions, insurance companies, they need to find investment solutions that could meet their longer horizons liabilities or longer duration needs. And it will actually lead to not only infrastructure, but GNS, the green and sustainable side. So as we all know, there are some researchers have already shown that for investment with green and sustainable elements there, the long-term risks are better well managed, and it could generate actually a better performance. So from risk perspective, there could be potential carbon taxes going forward, and this will affect the availability probabilities for those assets, as well as the potential reputational risk if this is not well managed. So in short, the cost of doing business for those infrastructures could be impacted because of those newly imposed regulations by the governments or those respective regulators. So I guess that's the general views on infrastructures from the industry perspective.
Mm-hmm. Thank you. And Eugene, because the firm plays probably different roles in this space, and will you be able to share with us how you gain exposure to infrastructure, in particular GSIF, and how the exposure in terms of approach will be different from the traditional investment in traditional infrastructure.
Sure, thanks for the question. So in terms of how we gain exposure, I think two things. So one is an active part of the role that we're playing in the region is to try to unlock more deal flow. As Alfred just mentioned, the deal flow has picked up in the region quite a bit over the last 10 years or so. And there are some themes that we see in that. One theme is getting to a point where there's kind of a critical mass of projects that are happening under a similar structure rather than a bunch of one-off projects. So this is an approach that we found as quite effective to increase the deal flow. And so what we're doing as a development bank is trying to foster more of that. So for example, we have a program called Scaling Solar, another program called Scaling Wind. It's basically a program to help governments and host utilities to, rather than do 1 or 2 wind projects, to do 5 or 10 wind projects in a year, to really quickly scale up the opportunity for investors. And we find that that's a win-win for everybody, for investors, for the host government, and for the end customer as well, because there's a lot of efficiency. So that is an important aspect of what we're doing. That's, I think, a little bit different from pure financial investors. In terms of how we are getting exposure to the green and sustainable, really, I would say this has been green and sustainable investing has been a part of our philosophy for a long time. So it's really embedded in our processes and our origination approach. I would say the key thing for us, as I just mentioned, is unlocking more deal flow, which we can participate in, and also other investors can join us to participate in.
Mm-hmm. And Ivy, how have you been helping investors, issuers in unlocking these deal flows and providing more opportunities?
Sally, you've mentioned a very good point. I think, the major thing that when we talk with clients that, have infrastructure projects and seeking funding, I think a very important part of our discussion would be on screening of the project, whether they're eligible for the sustainable finance market. I think the ECMA, they have already provided us a very, a good guiding principle, the green bond principle, listing out, what sort of process to put in place for project selection, evaluation, and, demonstrate the use of proceeds are eligible. But still, because, different that clients, they have different, they are, located in different jurisdiction, and maybe, have to align with their local regulation, and also if they are seeking funding from the international capital market, then they will have to fulfill the international requirement as well. So I think a lot of time it would be focusing on, screening of their projects eligibility criteria. And I think the HKGFA GSIF report highlight an important part is that we really need a clear definition when it comes to infrastructure. So of course, we have already seen, the green bond standards and taxonomy that I've just mentioned, but still, like, infrastructure encompass a wider dimension, not only on environmental, but also on social and, governance as well. So in the report, we highlighted, we need a more standardized approach towards defining green and sustainable infrastructure. Of course, we've seen, there have been, standards such as SQL in the UK and Envision in the US that trying to, give some definition on but still these these are different rating schemes and methodologies. And so I think over the last 12 months we are we are very delighted to see there is a new set of guidance coming out, which is called the Fast Infra Initiative, which are specially designed to mobilize the private finance market, in order to fund the sustainable infrastructure investment gap. So basically, Fast Infra is set out requirements for infrastructure to demonstrate their ESG performance, and I think this is an area that we will closely monitoring and see how we can really leverage this kind of new initiative when we advise our clients.
Yeah, I feel just a little bit on this point about the fast infra. Is it something that has developed on an international basis, or do you think it will help to drive convergence on an international basis and have more consistency?
I believe so, because the Fast Infra, this is a scheme that is established by not only financial institution, but also with the involvement of NGOs, IFC being one, multi-development bank, with IFC being one of them, OECD, and rating agency, a huge collaborative efforts globally to put forward this Fast Infra scheme. So I believe this is a tool that we can leverage, and definitely worth more discussion on how we can utilize this scheme.
And Ivy highlighted the point about the consistency definitions. So apart from these, what are the other challenges that you encounter when you invest in infra? Maybe start from Alfred.
Sure, Sally. So I would say definitely I would divide it into both public and private, because for investments in the asset management industry, so for infra, it could be classified, in both public, no matter on equities or debt, as well as the private side, which maybe Chang-Chi and Eugene will be more familiar with. So on the public side, it is a bit better because no matter on the listed equity side, the transparencies or disclosures from the company has a bit more information that we could look into it and test for it, especially with the help from the ESG information providers these days. So from Amundi, as an asset managers, we do have our own proprietary ESG scoring system to ensure that all our public investments, no matter on debt and equity side, will fulfill our requirements in the ESG space. And in a very simple way, like what you mentioned earlier in the beginning, Sally, we'll do some exclusions or negative screening. In particular for infrastructure related, for example, if it's coal-related, I just quote maybe 1 to 2 examples on that. So for example, we will exclude all companies that developing or planning to develop new thermal coal capacities along the entire value chain. So it's not only related to mining, but it will be also related to productions, utilities, and even transport infrastructures, etc. So it's the entire value chain we are talking about instead of just on the miners. So also we will focusing on the revenue generation side. So we will also exclude, for example, companies generating over 25% of their revenue from thermal coal mining extraction. So these kind of exclusion policies have helped us to provide I would say, one of the best infrastructure solutions on the public side. So in terms of private side, I may want to use an example to easily illustrate, because we understand, like what Ivy mentioned, it varies quite a lot depending on the needs and requirements from different investors. So for Amundi, we have set up a French asset management firm authorized to operate by the French market regulator, AMF. And it is a joint venture between Amundi and EDF, who is the first, I would say, very first electricity producer in the world, as well as the first renewable energy producer in Europe. So in this particular vehicle, we act towards energy transition by investing in different renewable energy assets, such as solar, wind, and biomass. So I guess more importantly is what are being selected for in these particular vehicles. So we're focusing on 2 major stuff, which first is the physical assets of the energy transition. such as the renewable energy production units like wind farms, solar PV farms, or hydropower, etc., as well as the systems allowing to improve energy efficiency, like heating networks, cogeneration units, or waste to energy. So in terms of besides the physical assets, we also look at the services which contribute to the energy transition, such as the renewal of energy, existing infrastructures and the development of energy storage solutions. I guess Ivy has already mentioned there are some criteria taxonomy we have to come across and we have to agree on. So when we select each and every single asset under this particular vehicle, we have conduct a systematic ESG due diligence before we make any decisions on every single assets. So we implement a methodology to assess the ESG performance, the carbon footprint, as well as the, for example, the contribution to the energy transitions of the assets. So I guess it's very important to come up with some universal taxonomies or standards or consistency. So that's the reason why we also link these particular vehicles or all the investment assets to a few SDGs, for example, related to climate actions, related to the affordable and clean energy, as well as responsible consumption and production, etc. So at least from the investor perspective, they understand what kind of SDGs, for example, they're investing in these particular vehicles. So we do see there's a growing demand in Europe for sure, but for Asia Pacific in particular, as long as there's some supports from the governments or the regulators, I do believe that there will be a lot more growing demand in GCs.
Yeah, thank you, Alfred. Before I move to Chi, maybe I will ask Eugene to look at the question in the chat box about the pipeline, and I will come back to you later on. And Chi, maybe after what Alfred has said about the public and private funds, can you also share your experience or maybe cite one or two examples to see how you gain exposure through, for example, funds? Because today we talk about foreign talk a lot about the investment funds, how important it is in the infrastructure space. So can you share with us one or two examples, how you make use of investment funds, for example, co-investment or similar structure to gain exposure?
Yeah, sure. Thanks, Sally. For us, that's of course that as an insurance company, the debt is always the most important asset class. Because this actually provides the stable and long-term return and also the duration that we definitely need for investment. So most of our investments actually in the debt space. So we do most of our investment actually, we try to do it both ways. We do direct investment, and we also have cooperation with private funds to evaluate their co-investment opportunity, to invest in the co-investment opportunities that they present to us from time to time. And so this actually I also maybe lead to another issue that I may also want to bring up, is because the risk weighting for impact investment in the region is still less clear. So most of our investments, if it is in fund and also in either in funds or in other kind of unrated format, then the capital charge will be primitive. So that's kind of limit our capability to look at the funds that actually fit our return requirement with after deducting, we say the capital charge that put in place. Although those investments are in infrastructure, and although infrastructure definitely will agree, and the statistics from all the most research house shows that it shows its stability and high recovery rate. But because of the current environment on the capital charge space, so we still focus more on direct investment in the senior debt of infrastructure debt. Yes.
Mm-hmm. She brings up a very important point, which I will come back to later on, is what more can we do in terms of regulation, in terms of market, that we can foster the development of GCF. And before I ask each of you, maybe Eugene, about the question that I've raised earlier on from the chat box, can you share your observation regarding the pipeline?
Sure, and thanks to the participant who shared the question. So the question was, maybe just for everyone's benefit, whether the projects we're seeing in the pipeline have direct environmental impact, for example, clean energy or carbon reduction projects, or whether they are more traditional projects which fall within current ESG frameworks. So I think the perhaps a way to think about this is to look at climate projects, or you could say green projects and sustainable projects. So for green projects, which tend to be, the nomenclature tends to be defined around CapEx, and it's going into very specific assets like renewable energy. This is what I would say is the low-hanging fruit because it tends to be very easy to identify and classify. And then when you get into things that are less CapEx driven and are maybe more related to the way the operation of the company is managed, you then get into questions around the ability of the company to map their activities, to measure their activities, and to make sure that KPIs that they're agreeing to in the financing are things that they believe that they can actually measure and achieve. So I would say the pipeline is broadly falling into these two categories. We're seeing both. And I think an important part of this process, I mean, on this panel, we have participants from the financial services industry, but really a lot of the work to unlock this market is happening within the companies themselves. So it's the investment in the ability to map and measure and make sure the KPIs are robust. This is really the work that's going on in the companies. And I think financial institutions that are working to promote these asset classes, an important aspect of what we can do is to work with the companies to help them go through that process of mapping and looking at their own internal processes and procedures. And that's really where the future pipeline is going to come from.
Mm-hmm. Probably, Ivy, that's your observation as well. Maybe one question that in the chat box, will you be able to give some of your insights as to how to address this issue? The question is, early stage infrastructure presents challenges for green financing, given Hong Kong QAA guidance. Many of the Hong Kong's iconic projects, such as Lantau Tomorrow, do not easily meet these criteria, at least in the early stage. So what do you think about how these new funding sources can be channeled into the transitional infrastructure projects? Any advice or observations from Ivy or any other panel members? Any thoughts from any of you?
I think this is there's a huge challenge of, getting early stage infrastructure to tap the debt capital market, because I think lacking of stable cash flow, remains a question that, investor might have concern about. Greening of these kind of project doesn't, remove the, existing concerns on these kind of early stage infrastructure projects. But I think at the early stage, there is still things that we can do in order to make it as a more palatable investment option later on, when the cash flow become more material. For example, infrastructure, since it has a decades long lifetimes, so we have to make sure that the infrastructure built today is supportive of the long-term decarbonization strategy and to achieve the goal of Paris Agreement. So I think on that note, government can play an important role in leading by example, like the Northern Metropolis project that you just mentioned. Whether it's possible for the government to really showcase that they have adopted some sort of climate scenario analysis, or referring to some existing guidelines such as TCFD, in order to demonstrate that they have applied a climate change adaptation lens when assessing any risk related to the infrastructure projects.
Yeah, thank you. Eugene, you can share your insights because you have a wealth of knowledge in this. And also one question to follow up on your earlier discussion about, can you illustrate or give any example to illustrate the company KPI that you mentioned earlier? So 2 questions for you. Thank you.
All right, thank you. Yeah, so for early stage, I can share a general observation about what we've seen in the infrastructure market really over the last 10 years, is that in the earlier phase of infrastructure fund investing, the funds were primarily coming in after the asset is operational, when it's de-risked, or sometimes coming in to take an element of ramp-up risk on the revenue or even some construction risk. And what has changed in the last 10 years is, in order to get proprietary deal flow and get lock in higher returns, infrastructure funds have actually gone into the business of seeding assets. So coming in and acting as developers of assets and taking that early stage risk. So I think that exposure to that type of, that part of the infrastructure life cycle is available in the market. And it's a very important thing that's happening. Infrastructure funds, I think, are doing that quite well, especially in OECD and kind of middle income countries. And organizations like IFC, we're trying to play that role in some of the more frontier countries in the region. In terms of the KPIs, I'm trying to think of what would be a good example. So there's a very interesting application in the market, which is offered by a small number of companies, which is really around how the aircraft are used when they are on the ground, which is interesting. I think most of us think about the fuel consumption point to point, but actually the way that the aircraft are managed on the tarmac actually does have a significant carbon footprint. And generally, this is not something that historically has been tracked by the airlines. So what is interesting is that there are these companies that have developed these technologies to help the airlines track this on a per pilot basis. And then it becomes part of the training program of the companies to say, okay, after you've brought the plane down onto the tarmac, how good are you as a pilot in minimizing the fuel consumption? So this would be an example where it's you have to have the systems and procedures in place in order to unlock it. And then once you have those in place, that gives the company the confidence to say, okay, we now know how to measure this. We now know how to track this. We know how to train for it to get the improvement. We now have the confidence to say, okay, we can make this a KPI in a financial instrument that we're going to put into the market.
Yeah, thank you. Very interesting. So in the last 2 minutes, maybe I'll ask Alfred and Chi, your last words as to what would be your suggestions as to unlock the potential and enable you to have more exposure to GSIF? Maybe start with Alfred.
Sure, Sally. And I would say it is a cooperation among all the industry practitioners in this space, but in particular, I do believe that the government or the regulators could play a very important role in this juncture. So for example, some of the European insurance regulators, they have imposed less risk capital charges for green related investments, in particular for GNS infrastructure. And I do believe that this could incentivize the insurance companies to invest a lot more in GNS infra, because I would say it is not only related to the supply side, it's supply and demand side. because like what Joseph mentioned in the beginning remarks video, the Hong Kong government has already issued quite a bit of green bonds, and there's a dedicated green bond programs already. That's the supply side. But for demand side, we have to create incentives, or the regulators or authorities have to do a bit more to push on the demand side, so that we could create a complete ecosystems to promote the GNS infra. And not only insurance authority, but also like the MPFA. So the MPF platform is talking about 150 billion US dollars, and which we don't have anything could be invested in infrastructure, not to mention about GNS. And of course, it would be the first step to include infra, and hopefully then GNS will follow. So there's a lot of potentials or on the demand side that we could work on to promote the GNS infra here in the region.
Yeah, thank you. And Chi, you echo with what Alfred has said, and probably should lobby the IA to take reference from the European approach.
Yeah, definitely. Yes, fully agree that what Alfred said, that European insurance regulators definitely at the forefront of this. I think it's quite a few years ago already when they created so-called Solvency II, the qualifying infrastructure investment kind of Solvency II, that they specifically list out the criteria that the infrastructure can that need to make in order to be a so-called high quality infrastructure project. So once they meet those criteria, they've been regarded as high quality infrastructure project, and they don't actually need a rating to justify a lower capital charge for the investors. So this is very important for ourselves. So the issue is so far that although infrastructure do have all those merits, from the capital charge perspective, it is not that there's no preferential capital charge for that in many of the jurisdictions in the region. So sometimes it is even more punitive to invest in infrastructure comparing to unsecured corporate bond, for example. Even though we understand the internal stability and high recovery rate of these assets. So this is very important, and we do encourage the regulators in the region to consider this, and they can also talk to the rating agencies. I understand both S&P and Moody's, they provide, they have already performed quite a lot of studies on the historical performance of the infrastructure and showing its stability and high recovery rate. So maybe that the regulators can also have a discussion with these rating agencies to get themselves comfortable on this, and when they come to get themselves comfortable to apply the preferential risk rate on infrastructure assets. And of course, that's also maybe there could be a dedicated agency to form that can provide the linkage between the investors like ourselves and the debt originators and the issuers. So the agencies can collect our feedback, and then kind of when they talk to the debt originators, when they talk to the issuers, they can convey all those requirements. So we still see quite a lot of roles that can be played by the regulators.
Yeah, thank you very much. So Florence, you see that there are a lot of inputs from the industry, and there's definitely a room, much room for improvement. And under your leadership and under your work group, we definitely will continue to provide more substantive input to drive this very important cause. This is only the beginning. So we'll have to rely on you to take the lead to help us on this very important subject. So with that, I'll pass it back to Jenny.
Great. Thank you to the speakers and also to the attendees for joining this call today. Obviously, clearly, there's a lot more that we need to be doing and to be driving. And with your input, I'm sure we'll be able to get there. So thank you very much for joining the session. And please feel free to reach out to any one of us if you'd like some more information on green and sustainable infrastructure and the way forward. Thank you.
Thank you.
Thank you.
Thank you.
Thank you.